Halfway through the current presidential term, a quick look at the stock market paints an overwhelmingly positive picture. The S&P 500 index recently scaled unprecedented heights, surpassing the 6,300-point mark for the first time ever and charting 8 record closes in the past month alone. This bullish trajectory persists despite a global landscape fraught with escalating trade tensions, geopolitical unrest in the Middle East, and persistent challenges to the central bank's autonomy, factors that might otherwise suggest a far less stable environment. Indeed, major indices, including the stock market and digital currencies like Bitcoin, have surged to new all-time highs. Concurrently, bond markets have resumed their steady ascent, and volatility in oil prices has notably subsided. Overall, global markets have demonstrated remarkable resilience throughout the year. This prevailing calm on Wall Street marks a significant shift from early April, when the S&P 500 dipped to its lowest point in over a year, teetering on the brink of a bear market following the administration's initial tariff announcements. Investment strategists have remarked that the market's recovery since then exemplifies the classic wisdom of bull markets often climbing a wall of worry, asserting that a plethora of concerns hasn't hindered its upward climb. Even as an August 1st deadline for new tariffs approaches, introducing fresh layers of uncertainty, markets are holding near record levels. Investors appear to be shrugging off a myriad of worries, yet U.S. stocks are trading at historically expensive valuations, setting the stage for a critical test of market momentum. A key factor supporting this rally is the widespread premise that any tariff increases implemented on August 1st will not be permanent. Market strategists suggest that the persistent prospect of future deals being struck continues to deter aggressive selling by traders. Experts also highlighted the S&P 500's unusually sharp and swift V-shaped recovery from its early April low, describing it as one of the most powerful post-correction rebounds in stock market history. However, the sheer ferocity of this recovery has prompted questions about whether it is genuinely supported by underlying economic fundamentals or if it masks inherent weaknesses. Despite periods of significant volatility in recent months, stocks have continued their upward push. The S&P 500, for instance, has gained over 5% since the beginning of the current administration. The president himself has acknowledged the market's robust rebound, noting the positive reception of tariffs and the stock market reaching new highs. Analysts from a major asset management firm suggested that a softening of initial tariff announcements removed worst-case scenarios for economic growth and inflation outlooks, thereby bolstering the market's rally. Furthermore, a chief strategist at a leading trading platform indicated that the rally has been significantly propelled by momentum and a fear of missing out, FOMO. This sentiment has encouraged investors to continue buying, betting on the postponement, renegotiation, or watering down of tariffs. Meanwhile, Bitcoin recently achieved a record high above $123,000, coinciding with legislative efforts in Congress to regulate cryptocurrencies. Economists at a leading consultancy firm anticipate the U.S. economy will likely withstand the global trade war, enabling the S&P 500 to climb further. However, they also cautioned that the administration's unpredictable approach to trade and its challenges to the central bank's independence could trigger a market downer. They noted that the widespread market assumption of limited tariff escalation and the central bank chair remaining in place might prove overly optimistic. More recently, the S&P 500 has experienced a notable slowdown in momentum, with no daily gain or loss exceeding 1% for an extended period. Bitcoin, too, saw a slight pullback, trading around $119,000 recently. Some investment advisors voiced concerns about market complacency regarding potential risks, especially given the historically high valuations of stocks. While stocks and bonds have navigated these turbulences relatively unscathed, the US dollar stands out as an outlier, continuing a precipitous decline. The US dollar index, measuring its strength against major foreign currencies, has fallen nearly 11% since the current administration took office. Conversely, gold and silver have served as traditional hedges against trade uncertainty, soaring 30% and 35% respectively this year. The recent market rally has been predominantly driven by retail investors, individuals directly purchasing stocks, rather than large institutional players. An equity strategist at a global bank estimated that retail investors poured over $50 billion into global stocks in the past month alone, indicating their significant role. Investors who seized the opportunity to buy the dip during the market's April slump have been significantly rewarded, witnessing an extraordinary climb to fresh highs. The S&P 500 has surged nearly 27% from its April low, while the tech-heavy Nasdaq Composite has soared almost 37%. The smaller Nasdaq 100 has maintained an impressive streak of over 2 months without falling below its 20-day moving average, a feat nearly matching a record set in 1999. Additionally, institutional capital that had remained on the sidelines has begun cautiously re-entering the market. A July survey of global fund managers revealed the biggest surge in risk appetite on record, alongside the most bullish sentiment observed since February. A respected market analyst and former economist characterized the administration's tariff announcements not as signs of retreat, but as persistent attempts to test what can be gotten away with. This strategy, he explained, drives a continuous cycle of new threats, partial withdrawals, and subsequent renewed threats. As stocks hover near record highs with the president's trade deadline looming, the ultimate question remains: will the market push back against the administration's plan to disrupt international trade, or will it remain complacent in the face of escalating uncertainty?